Good morning, everyone. Thanks for joining in. And in today's session, what we will be covering is some important questions from accounting standard. So I have selected few questions based on the past, practice manuals and all which were published. So we'll be taking up those questions, and as we discuss those questions, we'll also be covering the relevant concepts. Okay. And the idea is to make you ready to tell you where students make mistakes, to help you understand where you can score more marks. See, sometimes what happens is you know the concept, but you're not able to score full marks. Now, because accounting standards cover up to 60 to 70% of the examination questions, what we need to ensure is we are thorough, and also very important part here is how to present the answers or how to score out marks, okay, in accounting standard question. So we'll start from accounting standard 2. As we discuss, we will be taking up the relevant concepts, and we'll ensure that we are ready for the examination. And trust me, a lot of these questions have potential to come in the exam, similar questions, because if you evaluate last 10-15 years, a lot of questions are repetitive in nature, some change here, some change there. All of that would be covered. I hope the audio video is clear. There is not much of a lag. Voice is very low. Voice is very low. Is anyone else feeling that the voice is low? Do I need to increase? Just a moment. Is anybody else feeling that volume is low? Good morning, Bharat. Good morning, Rakesh, Swati, Mina. If you can give a go ahead on the voice, then we can start. Okay, Kanan, thanks for confirming. If you're facing it low, you can maybe increase the, put it on speaker or increase the volume of your device. I'll also try to speak slightly louder so that it is clear. Okay, so first we'll start with accounting standard 2. Accounting standard 2, the golden principle that you have to remember is inventory valuation is lower of what? Lower of cost and net realizable value. Now here, one specific area where students get confused is when we talk about raw materials. Whenever we talk about raw materials are valued at cost only. We will always value raw materials at cost unless, what is the answer? Unless finished goods will be sold below cost. If finished goods are sold below cost, then what will you do? You will value them at replacement cost. Okay. Now, here students, what they think is, if cost is, for example, 100, replacement cost is 120, we should value at 120. No. Cost always has to be considered. You cannot value inventory at a price which is higher than cost. Okay. So that is one thing you have to keep in mind to ensure that you don't make a mistake in the examination. Sometimes to trick you, they can give a higher replacement cost. That point of time, you will value it only at cost. If replacement is lower than cost, then go ahead with the replacement cost. So let's look at this question. A company purchased raw material at 400 per kg. Company does not sell raw material, of course, but uses in the production of finished goods. Finished goods in which the raw material is used are expected to be sold below cost. So if finished goods in which raw materials are included are expected to be sold below cost, then what do? We will consider cost or replacement cost, whichever is lower. While writing the answer, you will say, because finished goods in which raw materials are used are sold below cost, the better way to value the inventory would be replacement cost. At the end of the accounting year, company is having 10,000 kg of raw material. Company never sells the raw material. It does not know the selling price of the raw material and cannot calculate the net realizable value. Also remember, net realizable value is equal to selling price minus cost to complete minus cost to sell. Okay. Replacement cost is 300. How will you value the inventory? So the very important part here is materials and other supplies held for use in production of inventories are not written down below cost, or you can write it as they are valued at cost. if the finished products in which they will be incorporated are expected to be sold at or above cost. However, when there has been a decline in the price of material, it is estimated that the cost of finished goods will exceed net realizable value. Materials are written down to net realizable value. In such circumstances, replacement cost may be the best available measure. Now, you will not be able to remember all of these for examination. So, the way you have to write is, normally raw material are valued at cost. If there is fall in raw material prices and
here's what I found.
And finished goods are sold below cost, raw materials are written down. Written down to what? Written down to your replacement cost. So valuation will be 300 per kg. Okay, that's a very simple question. A lot of time these questions are tested. So I've seen students making mistake that if replacement, for example, if replacement cost, if they have given here, is not 300 but 500, then you will not consider 500. Then you will consider 400 only. Okay. Next one. Anil Pharma ordered 16,000 kg of material at 160 per unit. Purchase price includes GST of 10 per kg, in respect of which full input tax credit is available. So 160 is the purchase price, and from that purchase price, because it includes 10 rupees per kg, 160 minus 10, 150 is your relevant cost. Freight incurred 140, 160, transit loss 2%. Now, what we'll do is, how do we account for transit cost? So the way you have to say is, if ordered is 100, received is 98. If ordered is 16,000, how much will we receive? We will receive, just get the calculator. We will receive 16,000 into 98%, we will receive 15,680. So whatever will be the cost, the entire cost will be allocated to 15,680 units, because there is a normal loss of 2. Okay. Company actually received 15,500. So we should have received 15,680. We received 15,500. What is the balance? What do we call the balance? From 16,000 to 15,680, whatever is the difference, 320, this is called as normal loss. Instead of 15,680, we received 15,500. Then what is the difference called? The difference of 180. This difference of 180 is called abnormal loss. Normal loss is considered in the cost of inventory. Abnormal loss is not considered. Okay, so now how do we approach this? 16,000 into 160, the total price paid. Then you will get input tax credit. So other way to do that is 16,000 into 150. If you do 16,000 into 150, you get 24 lakhs. So this also you can do. Add freight. Freight is how much? 14,160 you will add. So the total cost is 25,40,160. This total cost of 25,40,160 is for 15,680 units, what we have calculated here. So per kg cost comes to 162. Okay. Then abnormal loss 180 kg we have already calculated here. So what we have to do is, what the question has asked, company actually received 15,500 and consumed 13,600. Compute the cost of inventory under AS2 and amount of abnormal loss. Now here when they are saying compute the cost of inventory, only raw material information is required, right? Now what is the closing inventory? See, we have received 15,500 and we have consumed 13,600. So 15,500 minus 13,600, if you see, closing inventory is 900. So 900 is the closing inventory, sorry 1900. 1900 is the closing inventory multiplied by this rate 162. This is the value of raw material. Abnormal loss 180. Using the same rate, 29,160 is the value of abnormal loss. If they give you opening stock, you take opening stock plus purchases minus sales is or minus closing stock is consumption. So you can use this formula and do the calculation, right? If you have any questions as I am discussing the questions, please let me know. We will definitely cover it, right? Now, this question, again, mark it as very, very important. They have tested this many times, both at intermediate and final level also, okay? So, this question covers almost every complexity that you can see in joint product costing. It has a byproduct, it has a scrap. So, this question you have to pay 100% attention, right? In manufacturing process of Vijay Limited, one product BP emerges besides two main product MP1, MP2 and scrap. So you have what? MP1, MP2 main product, byproduct and scrap. Detail of cost of production process is given below. Now MP1, MP2, these are joint products. Now cost for joint products are allocated normally on the basis of their realizable value at split of point or your relative sales value. Raw material is given, wages, fixed overhead, variable overhead is given. I don't know why this is getting triggered. Raw material, wages, fixed overhead and variable overheads are given, right? Then units are given and closing inventory is also given. Average market price of MP1 and MP2 is 80 and 50. This information is given because you have to allocate joint cost. You have to allocate joint cost in which ratio? In the ratio of the relative sales value. Byproduct is sold at 25 per unit. There is a profit of 5,000 on sale of byproduct after incurring separate processing charges of 4,000 and packing charges of 6,000. So what you have to do is whatever is the net realized value from the byproduct, that cost has to be reduced from the total cost. Also 6,000 was realized from sale of scrap. Whatever is the value of scrap, that also should be removed from the cost of your total cost. Okay, so here total cost is very simple and straightforward. Raw material, wages, fixed overhead and variable overhead. This is the total cost. From the total cost, what we need to do is whatever we have realized from BP, we have to remove. Whatever we have realized from scrap, this value, this also we have to remove. And whatever cost is remaining, that we will allocate between MP1 and MP2, right? So selling price of byproduct 25 is given, 1600, 40,000 less separate processing charges and packing charges 4,000 and 6,000. Sir, what do we do with the profit? That profit has been given to confuse you. What you have to do is net value, whatever is the net value or net realized value, that value you have to remove. Okay, so 30,000 is the value. Now cost, this you will take as it is from the question, raw material, wages and overheads. Net realizable value 30,000 of BP, scrap 6,000, so 36,000 is the benefit. Net cost is 30400. Now this 30400 you have to allocate between MP1 and MP2 on the basis of their relative sales value. Now how do we calculate the relative sales value? 6,250 and 5,000 is the output, right? So we'll take 6,250 and 5,000 output. Sales price is given, so 5 lakhs and 2,50,000. Ratio is 2:1. In this ratio, we'll allocate 3,04,000. So 3,04,000 into 2 by 3 and 3,04,000 into 1 by 3. That is the value of, that is the cost per or cost of inventory for per unit basis. Now what is the closing stock? 800 is given, so into 32, 25, 944. A lot of time what students make mistake here is they will just leave it here at 32 and 20. They will not calculate value of inventory. See the question, value of closing inventory. So here you have to calculate total value. I have seen, and if it is raw material, is given, then in that case you have to consider raw material inventory also. But here, so you have the cost also, right? So you have to consider the cost and calculate the raw material inventory as well. But here it's only MP1 and MP2. If they say total inventory, then raw material also has to be included, right? So that completes AS2. AS3, there is nothing much to be discussed in short form questions. Now, moving to accounting standard 4. Now, AS4 deals with events occurring after the balance sheet date. You have to calculate or you have to figure out what are adjusting and what are not adjusting or non-adjusting. Now, here the key principle that you have to keep in mind is there has to be an event on balance sheet date. There has to be an event on the balance sheet date. Only then you will consider adjusting and non-adjusting. The simple thing, for example, company deals in petroleum products. Sale price of petrol is fixed by the government. After the balance sheet date, before finalization, the government expect to increase the price retrospectively. Can the company account for additional revenue? Now here, you have to see in the timeline on the balance sheet date, was there any indication, was there any event, was there something that told us that yes, the prices will be increased? There is no such event. So if there is no such event existing on the balance sheet date, it is a non-adjusting event. Because it is a non-adjusting event, additional revenue cannot be accounted for. This is a very standard question. Preparing final accounts for the year ended 31st March, made a provision of bad debt. Last week of February, trade receivable had suffered heavy losses. Loss was not covered by insurance policy. In April 17, the receivable became bankrupt. So again, before the balance sheet date, there was a condition. What was the condition? There was a, the customer might become bankrupt. When did the bankruptcy happen? April. So event which gives additional information, information about events existing on the balance sheet date, you have to adjust it. So the key term that you have to remember, or when you have to write the examination, is that assets and liabilities should be adjusted for events occurring after the date of balance sheet that provide additional evidence to assist the estimation of amount relating to condition existing at the balance sheet date. So here the key thing that you have to do is additional evidence for condition existing at the balance sheet date. Here the condition was existing on the balance sheet date, there is an additional evidence, and hence you will have to provide for the entire 2 lakhs amount. AS5 based question. This AS5 based question is related to your prior period errors, accounting estimates and related aspects. Mr. Dinesh and company signed an agreement with the workers for increase in wages with retrospective effect. Retrospective means historically. Outflow on account of arrears for 13-14 was 10 lakhs, 14-15 12 lakhs, 15-16 12 lakhs. Amount is payable in September 16. The accountant wants to charge 22 lakhs, that is 10 plus 12, 22 lakhs as prior period charges in the financial statement of 16-17. Now, you can charge something or you can consider something as prior period only when there is an error or omission. Now, in this case, we are negotiating wages. When we are negotiating wages, there was no error in the past. So, because there is no error in the past, we cannot consider that to be a prior period item. That is one thing you have to mention, right? So, what do? This entire amount, 10 lakhs and 12 lakhs, whatever is for the previous period that we are paying now, all the amount has to be recorded in the current period only. You cannot record it as a prior period expense. Prior period item refers to income and expenses which arise in the current period as a result of errors or omission in the preparation of financial statement of one or more prior period. So if there was an error or omission, it could have been a prior period item, but because there is no error or omission, this item cannot be considered to be a prior period item. So the full amount of wage arrears paid to workers will be treated as an expense of current year and charged to P&L and not as current expenses and not as prior period expenses. Now here, one more thing is, because we are settling something for previous 2 years, and if this item is material, if this has to be brought to the notice of the stakeholders, then we have to disclose it appropriately. When items of income and expenses within the profit and loss from ordinary activities are of such size, nature or incidence that their disclosure is relevant to explain the performance of the enterprise, the nature and amount of such items should be disclosed separately. So very important, disclosure. Now it is not extraordinary. They can add some complexity saying, is it an extraordinary item? It is not extraordinary item because payment of wages is in the ordinary course of business. But yes, amount may be significant and hence we can present it as an exceptional item. Okay. Then moving on to accounting standard 7 on construction contract. So here generally 2 types of questions are asked. One is when there is an expected loss. Okay, so that is one question which is asked. Then other question that is asked is amount due from customer, amount to be paid to the customer. Okay, so these are the 2 last type of questions apart from disclosure requirements, of course, which are asked. Sagar Limited belongs to engineering industry. The chief accountant has prepared the draft accounts for the year ended 31st March. You are required to advise the company on the following items from the viewpoint of finalization of account, taking note of the mandatory standards. Company undertook a contract of building a crane for 10 lakhs. It incurred a cost of 1.5 lakhs and expects to incur 9 more lakhs. More for completing the crane, it has received 1 lakh as progress payment. Now here, what we have to do is, what is the expected revenue? The total revenue expected is 10 lakhs. What is the cost incurred? 1.5. What is the expected cost? 9. So total cost is 10.5. Revenue is 10, cost are more. So there is a loss of 0.5 lakh. This loss has to be fully provided. Okay. So when it is probable that total contract cost will exceed the total contract revenue, expected loss should be recognized as an expense. See, para numbers and all are not required, but at least accounting standard reference you have to give, right? So, expected loss is basically the total work certified, uncertified plus estimated cost to complete minus total value of contract. So here, work certified, not certified is not given. So what you have to do is, whatever is the cost incurred, the certified and uncertified, cost incurred, how much? 1.5 plus estimated cost 9. So 10.5 minus 10, that is 50,000. So the entire 50,000 of loss should be recognized as an expense in the same year. Okay. Sorry. This is very important. Question number 29 that I have circled. This question covers almost all the aspects that can be tested in the contract accounting. PRZ and Sons are heavy engineering contractors specializing in the construction of dams. From the records of the company, following data is available. Using this data, you are required to compute the amount of profit or loss for the year ended 31st March of 17, contract work in progress for the financial year 16-17, amount of revenue to be recognized out of the total contract value, work out the amount due from or due to the customers at the year end, and relevant disclosures. So basically the summary of everything. Total contract price 2,400, work certified 1,250, total pending certification 250. This is the total cost incurred. Estimated further cost 1,750. Stage wise payments received 1,100. Progress payments in pipeline 300. Right. So now based on this, what are we required to do? We are required to calculate first what I have said, profit or loss. Now for calculation of profit or loss, you need to calculate the stage of completion. Based on that, you will calculate the revenue that has to be recognized, cost that has been incurred, and if you have to provide for any losses, and then accordingly we will be able to do. Right. So now, if you see, to calculate the amount of revenue, we need progress. What is the cost incurred divided by total costs? That is incurred plus estimated. That is how you will calculate. Now here, total cost incurred is 1,250 plus 250, 1,500. Total cost incurred is 1,500. Then 1,500 is total cost. Expected cost to be incurred 1,750. So 1,500 plus 1,750. That will give you 1,500 divided by 3250. This will give you the progress. So progress is 46.15%. On this 46.15% on the total contract price, if you apply this, the revenue to be recognized is 1107. Very simple. How much revenue to be recognized? Then amount of profit and loss, what they have said. So let us see what happens. Work certified plus work pending certification put together is 1,500. Estimated further cost 1,750. Total is 3,250. 2,400 is the total contract price. If 2,400 is the total contract price, 3,250 minus 2,400, whatever is the number, 850, this is the loss. So this loss has to be fully provided for. So we are done with first one. We are done with second one, contract work in progress. That is 1,500. Then we have calculated the revenue. Now, very important, amount due from or due to the customer. Now, how do we calculate that? What you have to do is you have to see what is my contract cost. Whatever cost I have incurred, that I will recover from the customer. Okay. On this cost, I will add profit and reduce the loss. So contract cost minus losses. Because if, for example, if my cost is 100 and loss is 20, I will receive only 80 from the customer. So here also, if my contract cost, the total contract cost is 1500, from this I will reduce the losses 850, because I have already, incurred that loss which I will not recover from the customer, or I'll incur that loss and I'll not recover that from the customer. Then progress payments received. So what we have received from the customer, we have received 1100 and 300 we have, it's already in pipeline. So minus 1400, 1100 plus 300. So the amount 1500 what we have incurred minus 850 losses we will not consider, minus 1400, that is minus 750, means we have received more from the customers. So the 750 will be shown as a liability. Disclosure: what is the revenue, what is the contract expenses, recognized losses, progress billings, billed but not received 300, and gross amount due to the customer 750. Right? Any questions on this so far? Any questions, please feel free to ask, or if you want me to take up any specific question and solve it, that also that can also be done. Okay. Yeah. AS9 very important. So, but if you remember the basic principles, there will not be much of a complexity in handling these type of questions. Victory Limited purchased goods on credit from Lucky Limited for 250 crores for export. The export order was cancelled. Victory Limited decided to sell the same goods in the local market with a price discount. Lucky Limited was requested to offer a price discount of 15%. So, Victory is the buyer, Lucky is the seller. The chief accountant of Lucky Limited wants to adjust the sales figure to the extent of discount requested by Victory Limited. Now here, please understand, revenue you should always recognize at the agreed transaction price or at the gross value. Subsequent negotiations, subsequent discounts and all should not be reduced from the sales number. For example, if I have sold at 100, subsequently I gave a 20 of discount, revenue should be 100, 20 should be shown as discount. So, the company has sold to Victory Limited for 250 crores and sale was completed. See, another thing is, if I had negotiated the trade discount at the time of transaction itself, then in that case, we could have adjusted it as a purchase discount or trade discount. But here, discount is given subsequently, which has no bearing on the transaction, and hence you should not be adjusted. Prima Limited sold goods worth 50,000 to Messrs. Y. Messrs. Y asked for discount of 8,000, which was agreed by Prima Limited. The sale was effected and goods were dispatched. After receiving the goods, 7,000 was found defective, which were returned immediately. They made the payment of 35,000, accounted book sales for 35,000. Now here, what you need to understand is, we have sold for 50,000 and 50,000 and the discount is what? 8,000. So 50,000 minus 8,000, your revenue has to be 42,000 and 7,000 of goods which was returned, that has to be shown as sales return. Then moving on to accounting standard 10 on property, plant and equipment, a very simple example, a very simple standard I would say. And here the only part where you will find trickiness is revaluation. Apart from revaluation, I have not seen students struggling in this particular standard, right? So our focus will be subsequent revaluation and also component depreciation. So let's have a look at this one. XYZ Limited acquired a heavy road transporter at a cost of 1 lakh. Estimated useful life is 10 years. At the end of 6th year, the powertrain, one of its component, requires replacement as further maintenance is uneconomical. The remainder of the vehicle is perfectly roadworthy and is expected to last for next 4 years. Cost of new powertrain is 45,000. Can the cost of new powertrain be recognized as an asset? If so, what treatment should be used? Right now, here, how do you get it? Here, this is a case where you can follow component accounting. Initially, you do not have component accounting, but subsequently, what has happened? There is a cost of replacement of 45,000. Means you have replaced a particular part of the given equipment by paying 45,000. So, because it is a separate part, what you have to do? You have to recognize this 45,000 as a separate asset, and you have to de-recognize the estimated value of this existing part. So that is how the accounting treatment has to be given. This is a very simple question. Some cost have been given. So ABC is installing a new plant at its production facility. It has incurred this cost. Cost of plant, initial delivery, cost of site preparation, consultants, interest, estimated dismantling, operating losses. Advise ABC on the cost that can be capitalized in accordance with AS 10. Now here in this question, cost of plant, yes, you will capitalize. Initial delivery, yes, you will capitalize. Site preparation, yes. Consultants, yes. Interest charge paid to supplier for deferred credit. Now, normally, unless the asset is a qualifying asset, you cannot capitalize. Now here, the interest charges which are paid to the supplier for deferred credit, you are installing a new plant, they have not given whether it is for construction of plant or not there. So accordingly, you can make an assumption that this is not a qualifying asset and hence it is not capitalized. Estimated dismantling cost 3 lakhs. Please note this has to be done at present value. The question has not given present value, but you will write in the examination this estimated dismantling cost will be recorded at present value. Operating losses you will not capitalize. Okay, simple. Now this is what I was saying. Revaluation. Revaluation is a case where this PDF will upload it on the website and I'll add the link to the description. Okay, not all questions are relevant because some questions are advanced question. So you can ignore the advanced question from this PDF. Whatever is relevant at intermediate, that you can cover. Okay. A Limited has item of plant with an initial cost of 1 lakh. Date of revaluation, accumulated depreciation is 55,000. Fair value of the asset by reference to similar asset is 65,000. Past journal entries. Now what has happened? Cost is 1 lakh minus 55,000 is the depreciation. So carrying amount is 45,000. Fair value is 65,000. So what you will do? 20,000 you will debit to revaluation surplus. Right? Revaluation surplus. So transfer the accumulated depreciation to the asset account, debit the asset account and increase the revaluation surplus by 20,000. This is with respect to revision of depreciation. B Limited owns an asset with an original cost of 2 lakhs. Management determined that the useful life was 10 years and the residual value would be 20,000. Asset is now 8 years old and during this time there has been no revision to the asset's residual value. At the end of the 8 years, management has reviewed the useful life and residual value and has determined that useful life can be 12 years. So basically from 8 to 12 you have 4 more years. In view of the maintenance program adopted by the company, the residual value will be reduced to 10,000. So subsequently, residual value has been reduced. Now the question is, how would the above changes in estimates be made by B Limited? So here what has happened? Original cost is 2 lakhs. When did we do the revaluation? After 8 years. Useful life is 10, residual value is 20. So depreciation per year will be 2 lakhs minus 20,000 divided by 10 years. So 18,000. Okay. How many years we have used? We have used for 8 years. So 18 into 8 is 1 lakh. 44,000. Okay. So what is the carrying amount? Carrying amount is equal to 2 lakhs minus 144, that is 56,000. Okay. A lot of students, what they do mistakes, sometimes silly mistakes, is they will take 1,80,000 minus 1,44,000. This is not the approach to be taken. Okay. So 2 lakhs minus 144, 56,000. Now 56,000 is the carrying amount. And what have they said? Now the life at the end of 8 years, they have said life is 4 years and residual value is 10,000. So subsequently 56,000 carrying amount minus residual value 10,000. So 46,000 is the depreciable amount. This 46,000 over 4 years. So 14,4. So 14, 4. So 46 by 4, 4, 11, 44, 11 and 500. So 11,500 should be the depreciation subsequently. Simple question, and in these type of questions you should be able to score out of out. So this list can be a quick recap or revision for you. You can just go through it and understand what can be included in the cost and what are not included in the cost. Moving on to AS11, this is on your foreign currency. A company had imported raw materials worth US 6 lakhs on 5th of January when the exchange rate was 43. The company had recorded the transaction in the books at the above mentioned rate. Payment for import transaction was made on 5th of April when the exchange rate was 47. However, on 31st March, rate of exchange was 48. Company passed an entry on 31st March adjusting the cost of raw material consumed for the difference between 47 and 43. Now tell me, here we have purchased something, so we have purchased inventory and we have a payable. Which of these two items is a monetary item? Is inventory a monetary item or is payable a monetary item? Is inventory a monetary item or is payable a monetary item? So out of these two, payable is a monetary item. Now as per accounting standard 11, this payable has to be restated. Inventory should not be restated. Now what has the accountant done? The accountant, I don't know how do they become accountant, they have adjusted cost of raw material. So this should not be adjusted. Raw material should be recorded at the rate of 43. And whatever is the difference between 43 and year end rate of 47, that has to be adjusted to payables. So monetary items denominated in a foreign currency should be reported using the closing rate at each balance sheet date. The effect of exchange difference should be taken into P&L account. Trade payable is a monetary item and should be valued at the closing rate. That is, it's 48, not 47. 48. 48 at 31st of March, irrespective of the payment subsequently at a lower rate. So, what you have to do? 6 lakhs into 48 minus 43. This is 5. 6 lakhs, so 30 lakhs. This has to be taken to P&L. Subsequently, when you pay 6 lakhs, we have paid at 47, we have recognized at 48. So 6 lakhs of gain should be recognized in P&L. Should we adjust the inventory? No. Why? Inventory is a non-monetary item. So inventory, which is a non-monetary item, we should not be adjusting. Okay. Then this is with respect to an equipment purchase. Opportunity purchased equipment costing 24 lakhs on 1st of April and fully financed using a foreign currency loan in 4 equal installments. $1 4 equal installment. Exchange rates were $1, 60 and 62 on 1st of April and 31st March. First installment was paid in 31st of March. Entire difference in foreign exchange has been capitalized. You are required to state how this transaction should be accounted for. Right now, what you need to understand is you have something called as paragraph 46A. Paragraph 46A, exchange difference related to a foreign long-term foreign currency loan which is incurred on a asset that can be capitalized. So that is allowed as per paragraph 46A. Okay. So as per 46A, it can be capitalized. So if 46A is followed, then so if this kind of question comes in the examination, you have to be smart and you have to say as per paragraph 46A, this can be capitalized. Okay. No need to do this calculation. AS12 will come back subsequently with some questions from my material which we can use to discuss. Now moving on to accounting standard 13 that deals with investment, reclassification of investment. So reclassification means short-term investment or current investments being classified as non-current or long-term and vice versa. Decide on the treatment to be given in each of the following cases. First, a portion of current investment purchased for 20 lakhs to be reclassified as long-term investment as the company has decided to retain them. The market value on the date of balance sheet was 25 lakhs. Now, what is the cost of investment? Cost of investment is 20 lakhs. What is the value on reclassification? 25 lakhs. Now, always remember the principle or the accounting policy prescribed by AS 13 for valuation of current investment is lower of cost and the net realizable value. Now, here 20 and the value is 25, so we have to consider lower only because just because it is higher value you cannot transfer it at the higher value, so the reclassification has to be done at 20 lakhs only. Okay, then another portion of current investment purchased for 15 lakhs has to be reclassified as long-term investment. Market value of this investment on the date of balance sheet is 6.5. Now lower 15 and 6.5. What is lower? 6.5. So we should revalue or we should reclassify it at 6.5. Then certain long-term investment no longer considered for holding purpose have to be reclassified as current investment. Cost is 80. They have been written down to 12 lakhs to recognize permanent decline. Right. So 18 and 12. Whatever is the carrying amount, 12 lakhs is the carrying amount. That is the valuation. X Limited made investment of 600 lakhs in the equity shares of Y Limited, which 50% is made in the long-term category and rest as temporary investment. The realizable value of all such investment becomes 200 lakhs as Y Limited has lost a case of copyright. How will you recognize the reduction in financial statement? So please remember, short-term, anyways it will be lower of cost and realizable value. For long-term investment, what you have to see is there a permanent reduction? What the standard uses the term other than temporary. Okay, if there is an other than temporary diminution in the value of investment, we have to provide for that. Now here in this question, they have said they have lost a court case. Most likely it is a permanent diminution. If it is a permanent diminution, this also has to be written down to the net realizable value. Okay, so 100 lakhs of current investment, 100 lakhs of long-term investment. Carrying amount of current investment is the lower of cost and fair value. So carrying amount will be 100. Long-term investments are carried at cost. When there is a decline other than temporary value of long-term investment, the carrying amount is reduced. Now here, Y Limited has lost a copyright case which has reduced the realizable value and it may affect the business and performance in the long run. Accordingly, it will be appropriate to bring it down to 100. Okay, unless you assume no, it is not temporary, it is not permanent, it is temporary only, then that answer will be different. Anishchit Finance Limited makes available you to the cost and market price of various investment. Right now, you are required to value. Okay, so they have not given short term or long term. Okay, they have not given short term or long term. We'll assume it's a short term because market price has been given. So equity shares lower, and it is not at a total level. Individual A cost or market price, so cost. B 24, C 36 lower, D 60, E 90, F 75, G 6. So this is how you have to do. Second, any loss of these cannot be offset against mutual funds, right? The investment in each category shall be considered scrip wise and cost and market value aggregated for all investment in each category. So that is how you will do the valuation. Inter-category adjustment of appreciation and depreciation in value of investment cannot be done. So that also should not be done. So you have to do script wise, and once you find the total will be the valuation of the inventory. AS15, very important because newly introduced standard for CA Inter. So we can expect some questions from here, and also at final levels also this is a thing that they keep on asking. So here a lot of questions will be around what is the actual return on plan asset, what is the net obligation, what is the net liability, what is the net asset. Around those things only the question will be largely asked. Following data apply to defined benefit pension plan for the year ended 31st March. Calculate the actual return. Okay. Now when you have to calculate the actual return, if you get confused using the tabular format, what you can do is you can use a T-shaped ledger format also. Okay. So here what they have said. Benefit paid 2 lakh, employer contribution 2 lakh 80,000, fair market value beginning end 1140, fair market value beginning 8. So basically, if you say assets, balance brought down, how much? 8 lakhs. Then the question you have to ask is benefit paid. If we pay the benefit, will my asset value increase or decrease? My asset value will decrease. So I'll put it on the credit side. Then contribution, when employer makes a contribution, my asset value will increase. So I will add it here, 2,80,000. 8 plus 280, 1080 minus 2 lakhs. Closing balance has to be 1080 minus 2, 8,80,000. This is the closing balance. Actual closing balance is how much? 11,40,000. The difference between these two, 1140 minus 880, 2,60,000. This difference of 2,60,000 is the actual return. Now, how do we present in the tabular format? Just take opening balance plus contribution minus benefit paid, we'll get some number. So, opening balance, contribution minus benefit paid, we get some number. Actual fair value is 1140. This difference, 260, is the actual return. Okay. This one talks about expected return and actual return. The fair value of plan assets of Anupam Limited was 2 lakhs in respect of employee benefit pension plan on 1st of April. So this is the opening balance. On 30th September, plan paid out benefits of 25,000 and received contributions of 55,000. On 31st March, fair value of plan asset was 3 lakh. Company made the following estimates. Interest and dividend income after tax payable by fund 10.25. Realized gain on plan assets 3 lakhs. Fund administration cost 3 lakhs. Expected rate of returns 10.25 lakhs. Calculate the expected and actual return on plan assets as per accounting standard 15. Right? So now if you see the thing, return on opening value of plan assets 2 lakhs. So whatever is the opening value of plan assets 2 lakhs, you get 10.25%, which is 20,500. Then on 30th September, plan paid out benefits of 25,000 and received inward contributions of 55,000. Normally, I don't expect this complication being tested in the examination, but still, 25,000 is the payment and you have received 55,000. Okay. So net amount that you have received is 30,000. On this amount, so if it is 10.25% per year, now they have not given whether it is full year compounding or half year compounding. What you can do is, one assumption is take 10.25 by 2. Second assumption is consider 5% and 5%. So basically 1.05 to the power of 2 minus 1. So this will give you 1.1025 minus 1, that will give you 0.1025. So basically we are saying 5% for first quarter, 5% per for second quarter. If at all this type of question comes in the examination, make that assumption. Okay, because 6 months, if it is 10.25 annually compounded every 6 months, 5% will be for the first period. So 30,000 for 5% is 1500. Expected return is 22,000. If you don't want to make it complicated, you can directly take 10.5% by 2 for 6 months period and calculate the expected return. How do we calculate the actual return? Again, take the opening balance. So this is the closing balance. How do we calculate the expected actual return? You will take the opening balance. So fair value was 2 lakhs, opening balance was 2 lakhs. So you will take opening balance of 2 lakhs plus contribution received 55,000 minus benefit paid 25,000. So you get 2 lakhs plus 55,000 minus 25,000. This 2,30,000. Closing balance is 3 lakh. 3 lakh minus 2,30,000. 70,000 is the return. Okay. Now coming to borrowing cost, this type of question is continuously tested for the examination time and again, where you have two types of borrowing. One is your specific borrowing 11%, 13%, and then general borrowing and then specific borrowing. All of that is mixed, and this has been treated differently in different papers also. That is also a risk here. So we'll follow what is the ideal suggested answer approach, and we'll solve the question. X Limited began construction of a new building on 1st of January. It obtained 1 lakh special loan to finance the construction of the building on 1st of January at an interest rate of 10%. So 1 lakh at 10%. This entire is your borrowing cost, which can be capitalized. Specific borrowing, full amount should be capitalized. The company other two non-specific loans are 5 lakhs and 9 lakhs at 11% and 3%. For this, you have to calculate weighted average cost or rate. The expenditure made were as follows: 2 lakhs, 2 lakh 50, 450, 1 lakh 20,000. Building was completed by 31st December. Following principles of A16, calculate the amount of interest to be capitalized and pass one journal entry for capitalizing the borrowing cost. Now, as I told you, 1 lakh into 10%, that 10,000 should be fully capitalized. All specific borrowings should be capitalized fully. Okay. Second, on this you will take the weighted average rate and calculate. Now for January, out of 2 lakh, 1 lakh is already spent. Out of 2 lakh, 1 lakh is already spent. Now when that 1 lakh is already spent, what will you do? 2 lakh minus 1 lakh, you will consider 1 lakh with the balance rate. So first we will calculate the weighted average rate. 5 lakhs, 9 lakhs, 5 lakhs into 11%, 9 lakhs into 13%. So the interest is 5 into 11%, 55,000, 9 into 13%, 1 lakh 17,000, and 14 lakhs is the total amount. Total interest is 1 lakh 72. So the weighted average cost comes out to 12.285%. Right? Now, how much is spent? 2 lakh, 250, 450 and 1 lakh 20,000. So what you have to do is 2 lakhs. Out of this 2 lakhs, 1 lakh is specific. So balance is 1 lakh. On this 1 lakh, if you assume at the beginning of the period, this is spent for 12 months out of 12 months, and the rate that you have calculated is 12.285%. Then April 2 lakh 50,000 multiplied by, so April to December is 9 months, 9 out of 12 into 12.285%. July 450, 4 lakh 50,000 into July, August, September, October, November, December, 6 months out of 12 into 12.285%. December 1 lakh 20,000 into 1 divided by 12 into 12.285%. So 1 lakh into 12.2 1 lakh into 12.285%. M plus, so this is 12,285 plus 2,50,000 into 12.285% into 9 divided by 12, that is 23035. Then 4,50,000 into 12.285% into 6 divided by 12, 27641 plus 1,20,000 into 1 divided by 12 into 12.285% is equal to 1,20,000 into 12.285% into 1 divided by 12, you get 1228.5. So 1228.5 plus 12285 plus 23035 plus 27641, if you do, you get 64190 plus specific borrowing 10,000. So the total cost will be 74190 to be capitalized. So they have done slightly complicated way. So what they have done is, here they have considered what is the average outstanding, that comes to 622,500. Out of that 622,500, what they have done, specific borrowing 100, remaining is 522, so you get 74,189. That is the same number we have got, 74,190. What I told you, the approach I told you is more logical and easy for you to follow in the examination, right? Cost of building 10,20,000, interest 74,189. So the total amount to be capitalized by a single entry. Mark this question as very, very important, has been tested time and again, and students get confused in the examination with this question. The next one, the borrowings profile of Santra Pharmaceutical set up for manufacture of antibiotics are at Navi Mumbai is as under. 1st January 15% demand loan 60,000, acquisition of fixed asset, incidental expenses 8.33. 1st of July 14.5% term loan. 1st of October 14% bond, acquisition of fixed asset, acquisition of plant and machinery, incidental cost. Incidental expense consist of commission and service charges for arranging the loans and are paid after rounding off to nearest lakhs. Fixed asset considered as qualifying assets are as under 10 lakhs, 9 lakhs and 10 lakhs. The project is completed on 1st of January and is ready for commercial production. Show the capitalization of the borrowing cost. Right now here, on 1st of January there is a 15% loan. On 1st of July there is a 14.5% loan. This is only for 6 months. On 1st of October there is a 14% loan. Is only for 3 months. So what I have to do is, respectively, and they are given purpose also, acquisition of fixed asset, acquisition of plant and machinery, acquisition of fixed asset, and fixed assets considered as qualifying is these three. So these three are given directly. Right now, 14.5% term loan for plant and machinery, for acquisition of plant and machinery. Fixed asset is your general, because they have not specified which fixed asset is there. But plant and machinery, they have specifically told that there is a plant and machinery, and here is this plant and machinery. Right now, what is the cost? 40 lakhs into 14.5% for 6 months, 2,90,000, and incidental cost of 5%. It is not per annum. So if it is not per annum, on the entire 40 lakhs at 5%, you incur 2 lakhs. Please remember, as per accounting standard 16, incidental cost, processing charges, commission and all of those things, those are also a part of your borrowing cost. So you will capitalize the entire one. Then general borrowings, 15% demand loan 9 lakhs, incidental expenses 5 lakhs, 14 lakhs. So this is for full year. Then interest from on 14% bond 175, incidental expenses 4 lakhs. So 575. So total general borrowing cost is 1975. Right now, what you need to understand here is, first loan is outstanding for 12 months, next loan is outstanding for 3 months. So weighted average loans will be 60 lakhs into 12, 50 lakhs into 3 by 12, 72 lakhs 50,000. Okay. Weighted average borrowing cost 1975 by 7250 into 100, 27.24. right? And based on that, you will see what is the cost, 10 lakhs. Specific borrowing 0, balance cost 10 lakhs. Plant and machinery line 90 lakhs, 40 specific, balance is non-specific. Other fixed asset entire is non-specific, and accordingly we will calculate the capitalization. Now here I don't expect such an advanced question, but you can definitely get the question of what is to do with this particular incidental expenses, whether they have to be considered as a part of your borrowing cost or not. This is similar to what we have discussed earlier, so you can directly do it. Right, so it's been an hour. What we'll do is we'll take a 10-minute break, and then we'll move to the next standard, that is accounting standard 17 on segment reporting. So we'll take a break, and we'll resume at 10:40. Okay. So I went out, the camera went off. Just give me a moment. Okay. So we'll continue with accounting standard 17 on segment reporting. Generally, we don't see much questions, but if they test the questions, it's a very easy way to score marks in this particular thing. Right? Now here, the chief accountant of Sports Limited gives the data of following data regarding its 6 segments. So there are 6 segments given. We know, right? Segment reporting criteria, 10% criteria we have to apply and see whether a segment is reportable or not. Of course, using that we will see whether a segment is reportable or not. You have segment results, segment revenue. Now for segment results, what you have to do is sum of positives and sum of negatives independently you have to value, not that only this net number. Chief accountant is of the opinion that segments M and N alone should be reported. He is justified in his view. Please discuss. So, when is a segment reportable segment? Revenue from sales to external customers or from other transactions with other segment is 10% or more of the total revenue. So here you have to see total 1200. What is 10% of 1200? 120. Based on 120, this is reportable, this is reportable, these are not reportable. Okay, first one. So based on the first criteria, on the revenue criteria, only these two are reportable. Then profit or loss is 10% or more of combined result of all segment in profit, combined result of all segment in loss. So here what you have to do is you have to take profit 50, 60, 70 plus 30, 110. Then 190 and 10. So you have 200, right? So whichever is greater you have to consider. So 200 is greater. So 200 means 10% of 200 reportable, reportable, not reportable, reportable. So 30 also gets added. So based on this criteria, 30 also gets added. Then if the total external revenue, segment assets are 10% or more of the total segment of all the assets. So 200. So here it is 20. So what happens? This gets covered, this gets covered, this gets covered, this gets covered. So M, N, O, P, Q are covered under asset criteria. R is covered under results criteria, and again based on revenue criteria these are covered. So basically what happens, all the segments become reportable. Okay, simple one, but can be a good scoring question. XY Limited has 3 segments, namely X, Y, and Z. Total assets of the company are 10 crores. Segment X has 2 crores, Y has 3 crores, segment Z has 5 crores. Deferred tax assets included in the asset of each segment are 0.5, 0.4, and 0.3 crores. Accountant contends that all 3 segments are reportable segments. Now, please understand, segment assets do not include income tax asset. So that is one thing you have to keep in mind. If there is any segment asset, that should not be included or that should not be considered in your total asset. So from this 2 crores you have to reduce 0.5, from this 3 crores you have to reduce 0.4, and from this 5 crores you have to reduce 0.3. Okay, so what happens? 2 minus 0.5, 1.5, 3 minus 0.4, 2.6, 5 minus 0.3, 4.7, right? So that is there. Now based on this you have to see total asset is 10 crores, so threshold criteria is what? 2 crores. Sorry, 10 crores, threshold criteria is 1 crore. Based on this, all segments are reportable. So what the accountant is contending is right, but you have to reduce or you have to remove the deferred tax asset and then see the calculation. Achha, one more thing, this 10 crores also includes deferred tax asset, so that also we need to remove. So this will not be 10. 10 minus 0.5, 0.4, 0.3, 1.2. So this also becomes 8.8. So the key thing to remember is deferred tax asset are not a part of your segment assets. Related party, P Limited has 60% voting right in Q Limited. Q Limited has 20% voting right in R Limited. P Limited directly enjoys voting right of 14% in R Limited. is a listed company and regularly supplies goods to P Limited. R Limited has not disclosed its relationship with P Limited. Now, what you have to understand here is you have P, you have Q, and you have R. P has how much? 60% in Q. Q has how much? Q has 20% in R. Then R directly also it holds 14% in R. Okay, R is a listed entity, that is irrelevant. Management has not disclosed its relationship with P Limited. Now, what you need to understand is P through Q controls 20% and directly control 14%. So, the total control, if you see 20% plus 14%, total control that they have obtained is 34%. Okay, because I can tell Q what is to be done, I can control 20% and I can control 14% directly. For accounting purpose, when you have to calculate for associates and all, that time you will say 60% into 20%. But if your subsidiary is having 20% stake, the R becomes what? R becomes your associate. Now, when R is an associate, it is a group member, hence the control is higher, there is a significant influence and there is a related party relationship. Significant influence is defined as the participation in the financial and operating policy decision of the enterprise, but not in control. P Limited and R Limited directly and through Q Limited controls 34%. This I don't subscribe to this view. Significant influence may be exercised as an investing party holds directly or indirectly more 20% or more of the voting power. As R Limited is a listed entity and regularly supplies, therefore related party is disclosure is required. See this, whether or not it is a listed entity, you have to make the disclosures. Okay, disclosure requirement has to be fulfilled. Accounting standard 19, leases, very important. Question keeps on coming from this particular chapter. AS Limited has leased a machine to SB Limited on the following terms. Fair value of the machine 4 lakhs. Lease term 5 years. Lease rental per annum 1 lakh. Guaranteed residual value 0.2. Expected residual value 0.4. Internal rate of return 15%. Depreciation is provided on SLM basis at 10% per annum. Ascertained unearned financial income. Journal entries in the first year may be shown. So now what do we need? We need unearned finance income. What is unearned finance income? The gross investment in lease minus the present value that you will get or the net investment in lease. The difference of that is unearned finance income. Unearned finance income is the difference between gross investment in the lease and the present value of minimum lease payments under a finance lease from the standpoint of view of lessor and any unguaranteed residual value accruing to the lessor. Right? So now here, what is the gross investment in lease? Gross investment in lease is the total of minimum lease payment and any unguaranteed residual value. Now, what is the total lease payment? 1 lakh into 5 years plus guaranteed residual value 0.2. Total residual value is 0.4, guarantees is 0.2, unguaranteed is 0.2. Now, gross investment in lease is basically your 5 lakhs plus 0.2 plus 0.2, 5 lakh 40,000. So, this is the gross investment in lease. Total lease rent plus ZRV minus UZRV. Now, what is the present value? Discount factor is 15%. So, you will discount all the residual value and the guaranteed residual value and the unguaranteed residual value. You put all of that, you get 355,108. So, present value of minimum lease payment plus guaranteed residual value plus unguaranteed residual value. This is your net investment in lease. Gross investment in lease is the total value. So 540 minus 355,108, the difference 184,892 is your unearned finance income. Right? Now, when it comes to unearned finance income, on what is the question asked? In the books of lessee in the first year may be shown. Now, for the books of lessee, what you have to understand is, for lessee, the asset will be recorded as present value of lease payment plus guaranteed residual value only. For lessor, it is guaranteed plus unguaranteed. Okay. So, for lessee 354, 164 is important. So machinery to AS Limited 354 164. First year interest 354 into 15%. If you do, you'll get 51,775 and payment 1 lakh. Then depreciation charged for 5 on the machine. Now actually depreciation here, what they have said, 10% per annum, which doesn't look right because 5 years is the lease term, but still because they have given 10%, you have to consider the 10% rate and charge the depreciation. Suraj Limited, I don't have a company by the name Suraj Limited, okay, wishes to obtain a machine costing 30 lakhs by way of lease. Effective life of the machine is 14 years. Company requires only for the 5 years. So 5 out of 14. So this doesn't meet the finance lease criteria. It enters into an agreement with Ashok Limited for lease rental of 3 lakhs per annum, payable in arrears and rate of 15%. Chief accountant is not sure. If I was the chief accountant, I am very sure about the treatment of lease rentals and seeks your advice. So now what you have to do? You have to see what is the present value of lease payments. Okay, so present value of lease payment 3 lakhs for 5 years. So you can use, if you are not sure how to use it, 1 divided by rate is how much? 15%. 1.15 is equal to 1, 2, 3, 4, 5, and you do the grand total, you get 3.352. So present value annuity factor 3.36. I strongly believe institute should give the annuity factor in the examination so that you don't make mistakes in the examination because of these errors. Okay, so it's 3.36. So 3 lakhs into 3.36 is the present value of minimum lease payment, which is 10 lakhs. Now this 10 lakhs, if you see, fair value is 30 lakhs, so it is less than 90%. The lease term is also less than 75%, and hence it is an operating lease. So the 5 conditions they have given it, I'll quickly revise it for you. So they have not given. Anyways, the 5 conditions that you have to keep in mind when you look at lease is, one is present value of minimum lease payment at least 90%, lease term at least 75%, substantial part. Then there is an option to purchase which the lessee is likely to exercise. Then there is a transfer of asset, and lastly it is a specialized asset. So if any of these conditions are satisfied, the lease will be called a finance lease, right? If none of these are satisfied, it is called operating lease. Now here they have not given about bargain purchase, they have not given about transfer of asset, they have not given us about specialized asset. The term criteria is also not met, present value criteria is also not met, and hence it will be considered to be an operating lease. Esquire Private Limited has taken machinery on lease from SK Limited. The information is given below. Lease term 4 years, fair value at inception 20 lakhs, lease rent 625 at the end of the year, guaranteed residual value 125, expected residual value 375. The difference between these two, unguaranteed residual value, implicit interest rate 15%, discounted. This is what I'm saying. This they have to give. Calculate the value of lease liability as per accounting standard 19. Very, very simple. Present value of lease payment plus GRV will give you the lease liability. Right? So lease payment plus guaranteed residual value. Take the discount rate. This is the present value. Okay. So because the present value of minimum lease payment is less than the fair value, you will record it at present value. If fair value is less, you will record it at fair value. Okay. This is related to sale and leaseback. On 1st of January, Santa Limited sold an equipment for 614,460. The carrying amount of the equipment on the date was 1 lakh. Oh, so carrying amount is 1 lakh, sold for 614,460. So these kind of transactions are normally done for financing purposes. Sale was a part of package under which Banta Limited leased the asset to Santa Limited for 10 years term. Economic life of asset is estimated to be 10 years. Minimum lease rent by the lessee has been fixed at 1 lakh payable from 31st December. Incremental borrowing interest rate is 10%. Calculate the net effect on statement of P&L of Santa Limited. Right. First, you have to see what is the lease. Okay, what is the lease? Lease is 1 lakh per annum. You have to see whether it is a finance lease or an operating lease. The lease term is for 10 years. At the inception of lease, present value of the minimum lease payment is 1 lakh into 6.144. That is 10% per annum annuity. If you calculate, you get 6 lakhs 14,400, which is substantially equal to the fair value. Thus, the lease is a finance lease. So, the lease is considered to be a finance lease. If a sale and leaseback transaction results in a finance lease, the profit will not be recognized as income in the year of sale of Santa. It should be deferred and amortized over the lease term in proportion to the depreciation of leased asset. So this is one thing what you have to understand is, if it is a finance lease means what? Basically, the control is not transferred, the control is retained. You are taking it back on finance lease, so profit should not be recognized. So whatever is the profit, depreciation is 61446. Whatever is the total profit, 51446, this has to be recognized over a period of 10 years. Okay, so that is the thing. Now, on leases, you have to be very comfortable in preparing this table. Opening balance, payment, finance charges, and closing balance. If you are able to make this table, then it becomes simpler. Okay. Now moving on to accounting standard 20. This is on earnings per share. Very, very important and high scoring. You can score really high if you are able to solve questions based on this particular standard. More Limited has equity capital of 40 lakhs consisting fully paid equity shares of 10 each. Net profit for the year is 60 lakhs. It has also issued 36,000 10% convertible debentures of 50 each, convertible into 5 equity shares. Tax rate is 30%. Compute the diluted earnings. So whenever we have convertible instruments, convertible debentures, convertible preference shares, options, there we have to see whether earnings will get diluted. How to calculate earnings? Take the profit 60 lakhs, add back interest net of tax. Okay. Now, what is the debenture? It has issued 36,000 debentures of 50 each. So, 36,000 into 50, total number of debentures, into 10% divided by 100, into 10 divided by 100, you get 1,80,000. Now, 1,80,000 into 1 minus tax rate 30%. So, the impact will be 1,80,000 into 70%. Okay. So, 180 into 70%. If you do, you get 1,26,000. So what you have to do? You have to take 60 lakhs, add 1,26,000, you will get 61,26,000. Okay. From the following information of Beta Limited, calculate earnings per share in accordance with AS 20. 3 lakhs, 1 lakh, current tax 40/30, tax relating to earlier years 24/13, deferred tax 30/10. Profit 206/73. Other information. Profit includes compensation from central government towards loss on account of earthquake 2 lakh in 2014, 1 lakh. Outstanding convertible 6% preference shares. Conversion ratio 15 equity shares for every preference shares. I think this will be slightly advanced for you, so I'll skip this because at your level it will not be tested at this level. So okay, I'm skipping that question. Look at the next question. From the information furnished, you are required to compute the basic and diluted EPS for accounting year 16-17 and adjusted EPS for the year 15-16. Net profit 75,50,000. Net profit for 17, 1,25,000. Number of equity shares 50,250. Very odd number. Bonus issue on 1st of January of 17, 1 share for every 2 share held. So if you have 2 shares, you will get 1. So it is called 1:2. Number of 12% convertible debentures of 100 each on 1st of January, 1 lakh. Conversion ratio of debentures 10 share per debenture, tax rate 30. So there are two things. One is your bonus issue. Second is your convertible debentures, right? What are we required? Basic and diluted. Now here, whenever there is a bonus issue, you will do a retrospective adjustment and you will assume that the bonus issue was outstanding since the beginning of the previous period. Okay, so bonus issue was on 1st of January of 17. We are on 31st of March of 17. So you have to consider basically the bonus issue was done from the beginning of the previous reporting period, right? How many? Number of shares is 5 lakhs on 1st of April. On this you have given 2, 1 for 2. So basically 5 lakh divided by 2 if you do, you have issued a bonus of 50 lakhs divided by 2, 25 lakhs 125. Okay, that is the bonus issue. So when you calculate the EPS, you will take the total earnings and you will divide it by basic EPS, you will divide it by total of 50 lakhs 250 plus 25 125. Okay, so for basic earnings per share, that is what we will be doing. Then number of 12% convertible debentures issued on 1/1/2017, conversion ratio is 10 per share, tax rate is 30. So here we'll ignore this debentures, convertible debentures on for calculating basic earnings per share because if it is a convertible debenture, you have to consider it for diluted earnings per share, right? So for basic earnings per share, you will take 5 lakhs plus 25 lakhs. You will ignore this total earnings divided by this total. You get basic earnings per share. Then for the previous period, you have to readjust it. You will take the total earnings and do it with the respect to main shares plus bonus shares. For diluted EPS, how do we calculate diluted EPS? Now you have to see issued on 1st of January of 17. So what is the interest expense? Interest expense will be 1 lakh into 12% into 100. So 1 lakh into 12% into 100. That is 12 lakhs. Okay. So that is the total interest expense. Now out of that, what is the tax relating to the interest? 360. So your profit will increase by 1 lakh 1 crore 25,000 plus this impact. Now this we have to consider only for 3 months period. Why are we only considering for 3 months period? Because the tax impact will be there only for interest will be there only for 3 months period. Converted shares will be 10,000. Again, please remember two things. If convertible instruments are outstanding from beginning, you will take 12 by 12 as the weight. If convertible instruments are issued, when are they issued? On 1st of January. So if you have issued on 1st of January, you will not consider it to be for full year. You will only consider it to be outstanding for 3 months out of 12. So for weighted average calculation, you will take only 3 out of 12. So 50, 250, 25 and 10 lakhs into 3 by 12, whatever the shares you get, that divided by the total profit, you will get the diluted earning. So do we need to restate the previous period? No, you are not required to restate the previous period earnings per share in case of convertible debentures. One more concept here, what you have to understand in case of EPS is rights issue. Okay. So whenever we talk about rights issue, what you need to consider is, say for example, share price is, let us say, 100. X rights price, cum rights price, this is 100. Rights price is, say, for example, 80. Rights ratio is, let us say, 1:4. So for every 4 shares you'll get one more share. So we have to calculate something called as theoretical X right price. That is, a lot of time we get confused with the formula. So what you have to do is, how much have we invested currently, what is our current value of investment? So current value of investment is 4 shares we need at 100 plus 1 share we'll get at 80 divided by total number of shares, that is 4 plus 1. So that is 480 divided by 5, that is equal to 480 divided by 5, you get 96. This 96 is called theoretical X rights price. Now to adjust the EPS, to restate the EPS, we'll calculate a factor. Always remember, because of rights issue, the previous period EPS will go down. If you forget what to take in numerator, what to take in denominator, always remember the EPS will go down, and accordingly you will do the calculation. Moving on to AS21, question on minority losses. Just give me a moment. Ram Limited holds 80% in Sham Limited, its subsidiary. Share capital of Sham Limited is 25 lakhs. Reserves is 5 lakhs on the date of acquisition on 31st of December. Following are the reasons. Next year, 15 lakhs of losses. Then, next year, another 20 lakhs of losses. Then, another next year, 4 lakhs of profit. Next year, 5 lakhs of profit. Calculate the minority interest from the period 11-12 to 15-16 as per accounting standard 21. Right now, and they have also given the net worth amount. Now here, please understand, minority. Okay, minority cannot go negative because you will not recover the amount from the minority. So maximum it can go down is to 0. So let us see how do we do it. On the date of acquisition, share capital 25 lakhs. Plus reserves 5 lakhs, total is 30 lakhs. Sorry, 25 lakhs is the share capital, plus reserves of 5 lakhs, total is 30 lakhs. Okay, of this minority holds how much? 20%. So your beginning net worth of minority or minority share will be 6 lakhs. Now from this 30 lakhs, if you remove this loss of 15 lakhs, net worth comes down to 15. Another 20 lakhs of loss, net worth comes down to 5. Okay, so minority interest on the date of acquisition is 6 lakhs. Then 31st December they made for 31st March first year they made a loss of 15 lakhs. Minority share is how much? 20%. So you will reduce 3 lakhs. So 6 lakhs minus 3 lakhs, you are left with 3 lakhs. Then subsequent period, again there is a loss of 20 lakhs. So there is a reduction of 4 lakhs. Now minority has a balance of only 3 lakhs. You cannot take more than 3 lakhs. So what you will do, you will, out of the negative number, 1 lakh has to be borne by majority shareholders. Okay. So minority loss that is borne by majority shareholders is 1 lakh, which means out of that 6 lakhs, first year share of 3 lakhs is gone. Second year share of 4 lakhs we have adjusted till the extent of 3 lakhs. Balance 1 lakh is loss. Who will bear this 1 lakh loss? This 1 lakh of loss will be borne by majority shareholders. Then next year again there is a profit of 4 lakhs. Now out of this profit of 4 lakhs, 80,000 goes to minority. Now what you will do is, from this 1 lakh, first you will recover this 80,000 and you will show balance of 20,000 yet to be recovered. Okay. Then in the next period again there is a profit of 5 lakhs. Out of this 5 lakh, minority share is 1 lakh, and this 20,000 first we have to adjust, and the balance amount 80,000 will be with the minority. So the way it works is, first you started with 6 lakhs, then you had a loss of 3 lakhs, then again you had a loss of 4 lakhs. So technically you are minus 1 lakh. Okay. Subsequently, there are profits of 9 lakhs. Into 20%, you get 1,80,000. So balance is 80,000. But you will not show minority numbers as a negative item. Accounting standard 22 on deferred taxation. Omega Limited is working on, so deferred taxation, one simple principle that you can remember is now later pay. If you have to pay higher tax now, you will pay lower tax later, and that will result in a DTA. If you pay lower tax now and higher tax later if you have to pay, this will result in a DT. Okay. Omega Limited is working on different projects which are likely to be completed within 3 years. It recognizes revenue on percentage of completion method in the financial statement during 14, 15, 15, 16, 16, 17, 11 lakhs, 16 lakhs and 21 lakhs. Income tax purpose, it has adopted the completed contract method under which it has recognized revenue of 7 lakhs, 18 lakhs and 23 lakhs. So, this is the accounting income, this is the taxable income. Income tax rate is 35%. Compute the deferred tax asset liability for the years. Now what you have to see is, my accounting income is 11 lakhs, taxable income is 7 lakhs. So you have to ask yourself this question: will I pay more tax in the future or less tax in the future? See, out of 11 I have only offered 7. So in the future I will pay more tax. Because I will pay more tax on this 4 lakhs, it will be a DTL. At what? At 35%. Then 16 lakhs and 18 lakhs. Now here 16 lakhs is my accounting income. 18 lakhs is my taxable income for 15, 16. That's what they've given, right? 16 and 18. Okay. Now here accounting income is higher. Accounting income is higher by lower by 2 lakhs. Means this is now got reversed. Here if you see, the total income is 48. First year there was a 4 lakhs into 35% of DTL. Now, in the subsequent period, 2 lakhs gets reversed. So, 2 lakhs into 35%, 70,000 will get reversed, balance 70,000 will be the liability. And in the third year, entire amount gets reversed, so the deferred tax liability balance will be 0. Okay. Now, the other way to understand this is, year 1, it is simple. Year 2, 11 plus 16, 27 lakhs for accounting, 18 plus 7, 25 lakhs for taxation. So 27 minus 25, there is a difference of 2 lakhs. On that 2 lakhs, you will create the deferred tax liability. Rama Limited has provided the following information: depreciation as per accounting records 2 lakhs, depreciation as per income tax records 5 lakhs, unamortized preliminary expenses as per tax record 30,000. Okay, so depreciation in accounting is lower, for tax is higher. If depreciation for tax is higher, what does that mean? I will pay low tax now and I will pay higher tax in the future. So this will result in DTL. Because of unamortized preliminary expenses, what will happen is I will pay less tax in future. This will create a DTA. So here 3 lakhs of difference into 50%, 1,50,000 of DTL, and 30,000 into 50%, 15,000 of DTA. On a net basis, 150 minus 15, 1,35,000 is what you will present. So on accounting standard 23, yesterday itself I have released a full video on AS23 on our YouTube channel. You can have a look at this. Similar questions, whatever are important, all questions are covered there. Basically the study material questions, that is enough. Same thing is being discussed there as well. Let's look at this question. Bright Limited acquired 30% of East India. So if it is 20% or more, it becomes an associate. For 2 lakhs on 1st of June, by such an acquisition, Bright can exercise significant influence over East India. During the financial year, East India earns a profit of 80,000 and declares a dividend of 50,000. East India reported earnings of 3 lakhs for the financial year 31st March and declared dividends of 60,000. Calculate the carrying amount of investment in separate financial statement of Bright Limited, consolidated financial statement of Bright Limited. What will be the carrying amount as on 30th June in consolidated financial statement? Now, please remember, for associate accounting, you have to take cost plus share of profit minus dividend. This will give you the carrying amount in consolidated financial statement. In standalone financial statement, what will you do? You will calculate using the principles of accounting standard 13. Now, they acquired 30% of East India on which date? On 1st of June of 16. So, from 1st of April of 16 to 31st of March of 17, if you see, 3 months period is pre-acquisition. Okay. Cost is how much? 2 lakhs. They earned profit of 80,000 and declared a dividend of 50,000 on 12/8/16. I think some dates issue. Okay, it is entirely previous period, so entirely pre-acquisition dividend is given. So now, pre-acquisition dividend as per accounting standard 13, you will reduce it from the cost of investment. So what is the cost? Cost of investment is 2 lakhs. Dividend we have received is 15,000. 1,85,000 is the carrying amount for as far as the separate financial statements are concerned. Now, in fact, you can go ahead and make one more assumption that we have acquired on 1st of June. So whatever is the dividend declared for the next year, even in that, there can be a proportion of pre-acquisition dividend, but we will not get into that complexity. Then, carrying amount in the consolidated financial statement of Bright Limited, 185 plus share of profit as per the equity method. So whatever is the profit earned, that share of profit as it is, you will consider to be the part of your, you will add it to share of profit, whatever is earned, you will add it to the carrying amount. Then on 30th June, what you will do? Dividend that you have received, you will reduce that and you will get the closing balance. AS24 is a disclosure based standard, so you can do the disclosure revision part. Now coming to AS25 on interim financial reporting. The standard, because IFR is again added, we need to be slightly careful with AS23, AS25, AS27 and AS15. Okay. Just a moment. On 30th June, Ashmita Limited incurred 2 lakhs net loss from disposal of a business segment. On 30th July of 16, company paid 60,000 for property taxes assessed for the calendar year 16. How the above transaction should be included in the determination of net income of Ashmita for 6 months ended on 30th of September. Now, what has happened? Two things have happened. One, they have incurred net loss on disposal of business segment on 30th of June and we are looking at 30th September period. The principles that you have to follow when you calculate when you talk about interim financial reporting is that if there are some expenses which will be deferred, only those expenses will be deferred. Otherwise, other expenses will not be deferred. Now, 2 lakhs is the loss on disposal of a business segment. Now, tell me one thing. Will you defer the loss on business segment from 1 year to next year? You will not do that. Same way, you cannot do that from one interim period to another interim period. So, this 2 lakhs of net loss has to be shown in the same interim period itself. Whereas, property taxes is for the entire year. So, out of 60,000, 30,000 is for second half. So, that is like your prepaid. So, 30,000 will not be considered prepaid part, remaining 30,000 will be disclosed. If an enterprise prepares and presents a complete set of financial statements in IFR, the form and content of those statements should conform to the requirements as applicable to annual complete set of financial statements. As on 30th June, Asmita would report the entire 2 lakhs loss on the disposal of its business segment since the loss was incurred during the interim period. Cost, charges and expense in annual period should be allocated to interim period on accrual basis. 60,000 is for the entire calendar year, so 30,000 will be allocated. So that is how you have to answer. An enterprise reports quarterly estimates of annual income of 10 lakhs. Assume tax rates on 5 lakhs at 30%, balance at 40%. Estimated quarterly income tax are 75, 250. Estimated quarterly income are 75, 250, 375, 3 lakhs. Calculate the tax expense. So what you have to do is 10 lakhs is the income. 5 lakhs you will pay 30%. That is 1,50,000. And on balance 5 lakhs, you will pay 40%, that is 2 lakhs. Total tax payable is 3,50,000. Total income is 10 lakhs. So tax rate is 35%. You will use this tax rate of 35% to calculate the income tax expense for each period. Okay. Moving to accounting standard number 26. This is on intangible asset. Here, what you have to remember is research you have to expense. Development you can capitalize if criteria is met. So those 6 criteria of development expenditure capitalization you have to remember by heart, no choice. The company spent 45 lakhs for publicity and research expenses on one of its new consumer product, has to be expensed. How will you deal with this amount? So it has to be expensed. Very simple and straightforward. Company with a turnover of 250 crores and advertisement budget of 2 crores had taken up marketing of a new product. The company would have turnover of 25 crores from the new product. The company has debited P&L account the total expenditure of 2 crore as special initial advertisement campaign. Is it correct? It is correct, because advertisement expense, research expense you cannot capitalize. Only if you will get future economic benefits and if you can measure, you can attribute, you can identify that because of advertisement we have got so much, that is not possible, and hence it has to be capitalized. Okay, so there must be an asset. Unless you have an asset which is created, and that asset means you must be able to control the asset, you cannot capitalize. UK International Limited is developing a new process. During the financial year ending 31st March, total expenditure incurred was 50. Process met the criteria for recognition as intangible asset on 1st of December of 15. Means it met. Expenditure incurred till the date was 22 lakhs. Now this 22 lakhs has to be expensed. Further expenditure incurred in process for financial year 17 was 80 lakhs. The recoverable amount of the know-how was 72 lakhs. This includes estimates of future cash outflows as well. Calculate amount to be charged to P&L, carrying amount of intangible asset. So the 22 lakhs is recognized as expense. Whatever amount you spent before you met the criteria has to be recognized as expense. Then the production process is recognized at a cost of 28 lakhs. How? Total is 50, 22 is expensed. So 50 minus 22 will capitalize 28 lakhs. Then subsequent period, 28 lakhs is the carrying amount. Expenditure incurred 80 lakhs, total is 108. Recoverable amount is 72, which means the asset is impaired. If the asset is impaired, the impairment loss is charged to P&L. Impairment. Venus Limited has fixed asset which is carried in the balance sheet at 500 lakhs. The value in use is 400 lakhs and net selling price is 375. Calculate the impairment loss. Now while calculating the impairment loss, you have to take higher of value in use and net selling price. What is the value in use? 400. Net selling price 375. Which is higher? 400 is higher. So recoverable amount is 400. Carrying amount is 500. 500 minus 400, impairment loss is 100. Journal entries for adjustment of impairment loss debit to the asset. In the balance sheet, you will show it at 400. So, impairment loss to asset 100, P&L to impairment loss 100, that is the impairment loss accounting. In the balance sheet, you will show it at this one. Good Drugs Pharmaceuticals acquired a sachet filling machine on 1st of April for 60 lakhs. Machine was expected to have a productive life of 6 years. At the end of the financial year, the carrying amount was 41 lakhs. Short circuit occurred in this financial year, but machine did not get badly damaged and was still in working order. Machine was expected to fetch 36 lakhs. So, 36 lakhs. If sold in the market, machine by itself is not capable of generating cash flows. However, smallest group of assets comprising this machine is able to generate cash flows of 54 crore per annum and has a carrying amount of 3.46. All these machines put together could fetch a sum of 4.44 if dispersed. Discuss the applicability of impairment loss. Now, what you have to understand is, if the cash generating unit is not impaired, then the question of impairing the specific machine is not required. So, because the cash generating unit is not impaired in the given question, the related CGU, which is a group of asset to which the damaged machine belongs to, is not impaired. Only if the machine can independently generate cash flows, and if the group is impaired, then that's a different thing. Here, CGU itself is not impaired. If CGU is not impaired, the machine cannot be impaired because the machine does not generate cash flows independently. The recoverable amount is more than the carrying amount of the group of assets and hence no need to carry out impairment. From the following details of asset, find out impairment loss, treatment of impairment loss, and current year depreciation. Cost 56, useful life 10 years, salvage value nil, current carrying value 27.3, useful life remaining 3, recoverable amount 12, upward revaluation done in the previous year, 14 lakhs. Right? Now here, current carrying value current carrying value is 27.3, recoverable amount is 12 lakhs. So 27.3 minus 12, whatever is the loss, 15 lakh 30,000 is the impairment loss. But because you have a revaluation surplus, first you will set off the revaluation surplus to 14 lakhs, balance 1 lakh 30,000 will go to P&L. Whenever there is a revalued asset, think of it, impairment is also done as if it is revaluation. Moving to the last standard, accounting standard 29. Mostly it will be a theoretical standard, but again highly scoring. Exox Limited is in the process of finalizing its accounts for year ended 31st March of 16. The company seeks your advice on the following. Company's sales tax assessment for assessment year 13-14 has been completed on 14 February, demand of 2.76 crore. Company has paid the entire due under protest without prejudice to its right of appeal. Company files its appeal before the appellate authority, wherein the grounds of appeal cover tax on additions made in the assessment order for a sum of 2.1 crores. Now this question has come multiple times in the examination as well. Now here, what is the demand? 2.76. Have we accepted the demand fully? We have not accepted the demand fully. We are contending for 2.1. So out of 2.76, if you remove 2.1, we are left with 0.66. 0.66 we have accepted. So this 0.66 is my liability. Balance 2.1 I am contending. This is my contingent liability. And the amount I have paid, see, out of 2.76, I have accepted 0.66. 2.1 what is left over? That is my asset, because I have not accepted. I have paid the amount to the government. I am fighting. So 2.1 will be my asset. 0.66 will be the expense, and balance 2.1 will be the contingent liability. Since the company is not appealing against the addition of 0.66, the same would be provided in the accounts for the year ended 31st March. Amount paid under protest will be kept under loans and advances under asset 2.1. Also, 2.1 will be disclosed as contingent liability. The company has entered into wage agreement in May 16, whereby the labor union has accepted revision in wage from June 15. Agreement provided that the hike till May 16 will not be paid to the employees but will be settled to them at the time of retirement. Company agrees to deposit the arrears in government bonds by September 16. Now, you will settle it at the time of retirement. Is the amount fixed? Yes, the amount is fixed. If the amount is fixed and determined, then you will account for it as a liability in the current year itself. An oil company has been contaminating land for several years. It does not clean up because there is no legislation requiring cleaning up. On 31st March, it is virtually certain that a law requiring cleanup of land contaminated will be enacted shortly after the year end. Is provision necessary? So here, what you have to see is there a present obligation because of past event which will result in future outflow? Okay, so they are saying it is virtually certain that a law will be enacted. In future, there will be a law which will require me to rectify the mistakes of past. So past events have already happened. So then there is a likely obligation which will come up. A past event will lead to a present obligation when the enterprise has no realistic alternative to settle the obligation. When environmental damage is caused, there may be no obligation to remedy the consequences. The causing of damage will become an obligating event when a new law requires that existing damage is to be rectified. So, the oil company has to provide for cleanup cost in the year in which the law is virtually certain to be enacted. So, you have to ask yourself, because I have damaged the environment, is there any obligation? Yes, there is an obligation. So, I will have to provide for it. Vishnu Company in its financial year ended 31st March 15 has as its financial year of 31st March 15 lawsuits outstanding, none of which has been settled by the time the accounts are approved. The directors have estimated the possible outcomes as below. First 10 cases, so don't miss this, it has to be multiplied by 10. 0.60, 0.3 probability means probability of winning is 0.6, loss will be 0. Probability of winning is 0.3, loss will be 90. Probability of loss is 0.1, loss will be 160. So you have to calculate the expected value, 0.6 into 0, 0.3 into 90, 0.1 into 160. Same way for remaining 5 cases, you have to calculate the expected value. So expected value is 4,30,000 for the first case and 1,85,000 for the second case. Okay. The directors believe that the outcome of each case is independent of the outcome of all other case. Estimate the amount of contingent loss and state the accounting treatment of such contingent loss. Now you may say, sir, why are we not recognizing a liability? Because probability of loss is less. So it is probable that we will win. That is higher probability and hence no contingent liability is being provided. Okay. So the idea of discussing in this particular manner all the questions from the previous exams is that as we discuss this question, some of the concepts would get revised for you, and when some question is being discussed, you will figure out whether you are able to recall the questions or not. This PDF will upload it in the resources section, in the description section. You can download from there. We also have the notes and all the solutions provided. AS23 uploaded yesterday itself along with the video. You can have a look at it. Okay. That is how that is how you can have a look at it. And conceptual revision of these accounting standards, almost all the accounting, not everything, but almost all the accounting standards was done. Okay, so you can refer to the conceptual revision which is available on the YouTube channel, on our channel. I had done it, a quick revision that will help you to revise the concept. I hope the session was useful to you. You were able to get some additional insights on how to approach. Now in examination, remember to meet the requirement, working note is very, very important. You have to provide the working note. Check what the question is asking and your conclusion must be there accordingly. Don't leave answer halfway through. So for example, here, estimate the amount of contingent loss and state the accounting treatment. So you have to estimate the amount of contingent loss and also give the accounting treatment. If you just make the estimate loss calculation like this, you will not get full marks. You'll get only part marks. Okay. Same way, calculate the value of inventory. You have to calculate raw material, work in progress, finished goods as well. Same way, journal entry you have to pass if it is asked in the question. So that is how you will have to handle the questions in the examination. I hope this quick revision of about 2 hours was helpful for you to recap quickly the concepts that might be tested in the examination. I'm not saying this is a question bank, but you will be able to handle the questions better in the examination. Thanks a lot for joining in. We will have a follow-up strategic management part 3 live revision for the last 2 chapters on Saturday. So if you are writing group 2 as well, do join in. Thanks a lot.